Money is not just earned, it is understood. Welcome to MWH tutorial, where financial accounting, economics, and finance are made simple. Today, I'm going to solve a problem that has frustrated so many students. That is the concept of debit and credit. The concept of debit and credit. I know many beginners of accounting just fear this concept. Some memorize them to pass the exam. Yet, the idea behind them is very simple. Let me give you a simple example for better understanding. Musa saved 100,000 from his salary. 100,000 naira from his salary. One morning, he decided to start a business. Let's say selling phone accessories. He put the 100,000 into the business. Now, stop here a moment and think like an accountant. Ask yourself these simple questions. What did enter into the balance? What entered into the business? Ask yourself, what entered into the business? Remember, Musa brought 100,000 into the business. Now, simple question, what entered into the business? The cash Musa brought. Then you can answer the question here. Say cash. The second question, then you ask yourself, where did the money come from? Where did the money come from? Where? Remember, Musa introduced the money for the purpose of business. So you can say the money comes from Musa. From here, I'm trying to introduce you to a very concept of accounting. This is trying to tell you in accounting, for every transaction, it affects at least two accounts. It affects two accounts. That is the receiver and the giver. The account that gives and the account that receives. Where the money comes from and where the money is going to. The account that gives out the value, the account that provided the value. Now, let's answer this question. This is a very example. Let's say this is an account. Here are two accounts. This is what you call an account. A page of a ledger. This is what you call an account. So here are two accounts, capital account and cash account. Here is what we call credit. The CR here, CR stands for credit. DR here stands for debit. So whatever comes to debit is what you receive. Whatever goes out, we put it on the credit. When you receive a value, we put it on the credit side. When you give out a value, we write it on the credit side. Now, going back to this earlier example of Musa, where he introduced 100,000 naira for the purpose of business. Now we have answered this question earlier. What entered into the business? Cash. Therefore, we debited cash because we said debit is the receiver. So you are going to debit cash account. We want to debit cash with the amount that we mentioned, 100,000. Come and write 100,000. Then you come and write it the name capital. And remember, we said for every transaction must affect at least two accounts. We have written on one account. Where is going to be the other account? The other account should be capital. Where are we writing on capital account? Despite it was Musa that introduced the money. So normally in business, the money you start the business with, we call it capital. Just like, let's say for instance, the money you paid as bride price is called dowry. The money they pay to kidnappers is called ransom. You know, money has different names, just like that. So in business, the money you start business with, we call it capital. So Musa gave out the money. Musa is now representing the one that gave out the capital. Is the one that gave out the capital. So we debited here. Definitely we are going to credit here. So therefore we are going to credit here with the name, this name, cash. Come and write cash here. Come and write 100,000. Come and write 100,000. So now we have done the needful. I'm happy to introduce you to the golden rule of accounting that says for every debit entry, there must be a corresponding credit entry. For every debit entry, there must be a corresponding credit entry. For every debit entry, there must be a corresponding credit entry. For every debit entry, there must be a corresponding credit entry, and vice versa. So those. For every credit entry, there must be a corresponding debit entry. This is a general rule that you're supposed to understand for this. Okay, now let's look at this example for better understanding. I hope this one is understood. Let's look at the second example. The following information were extracted from the book of 11 Stars Enterprises for the month of March 2024. On 1st March, started business with cash 2,000. On 3rd March, bought goods on credit from Ekene. On 4th March, paid rent by check. On 5th, sold goods by cash 5,000. On 7th, returned goods to Ekene worth 200 naira. On 10th, 11 Stars paid Ekene his account in full. We are asked to complete the double entry. Let's show this. Let's demonstrate this. Don't always forget your currency sign. Whatever currency given to you in the question, make sure you apply it here. If you are giving dollar, use dollar. If you are giving naira, use naira. If you are giving CD, use CD. So, started business with cash 2,000 naira. The first thing you need to do is to identify the relevant account in that particular transaction. What are the relevant accounts here? Here, definitely account is involved. Cash account is involved. After cash account, which account? Remember I told you the money you started business with, we call it capital. So since they started here, therefore we are going to open cash account and the capital account. This one you are going to call them cash account and the capital account. Just like how we treated the first one, we ask ourselves what comes into the business, what goes out of the business. Cash entered into the business. So therefore, remember debit the receiver. We are going to debit cash with 2,000. Come around 2,000 here. With the name capital. With the name capital on 1st 2024. We are done with this. Remember we say for every debit entry there must be a corresponding credit entry. Then we debited here, we know that automatically we are going to credit here capital account. So therefore we come and write 2,000 here. With the name cash. Same month. We are done with this transaction. Then we are done with this. Next one is bought goods on credit from Ekene. As usual, ask yourself some question. What comes into the business? What goes out of the business? Who is the receiver and who is the giver? Bought goods on credit from Ekene. Debit, credit, debit, credit. As usual, identify the relevant accounts. I told you this is what you call an account. An account. What are the relevant accounts? Bought is equivalent to purchase. So you are going to open a purchases account. Purchases account. Purchases account. Then the second account is definitely going to be Ekene. So we are going to open Ekene account. Ekene account. Now, both goods on credit, the business, because you as accountant, you are representing the business. So they say both goods on credit, the business receives goods, right? Then we say the receiver, we say debit the receiver. So therefore we are going to debit purchase account. Purchase account. Debit purchase account. With how much? With 1,000. On 3rd with the name Ekene, with this name. You know that automatically you are going to credit Ekene account. Then you come to Ekene account. You have debited purchase and you have credited purchase. Why are we crediting Ekene? Ekene gave out the goods, and we say credit the giver. Ekene gave out the goods. Then paid rent by check, 300 naira. As usual, you are going to open two accounts and identify the relevant account and post your transaction. As simple as that. To identify the relevant account, remember, paid rent. You know, definitely there is going to be rent accounts. I may say by check. We don't have a check account, but instead we are going to open a bank account as check has been mentioned. So we are going to open bank account, and we are going to open rent account. Rent account. As usual, think who is the receiver, who is the giver. Business benefit from the rent and they pay cash for the rent. So therefore, you are going to debit rent and credit bank because business paid for the money. So therefore, come and credit bank. Bank paid for the rent. Bank paid for the rent. How much? The rent is 300 naira. Rent. The corresponding entry, it will automatically going to debit rent account because business enjoy the service of the rent. Therefore, you come and write 300 naira here as bank. It's fourth. We are done with this transaction. The next transaction is sold goods by cash, 5,000. Identify the accounts involved. Sales account will definitely be there, and cash account will definitely be there. Sales account. Sales account. And the cash account. Remember, we have cash accounts. You don't have to open another cash accounts. So therefore, we are going to ask ourselves who is the receiver and who is the giver. Cash received the money. Sales gave out the goods. So therefore, we are going to debit cash because cash received the money. We made the sales. When you made the sales, definitely the customer is going to give you cash in exchange. So you are going to debit cash with 5,000. All right, debit cash with 5,000. Come on, right. Sell on the 5th. Debit the corresponding entry. You are going to credit sales account and you come and credit sales account with 5,000. We are done with this transaction also. The return goes to a Ekene worth 200 naira. In business, when you made a purchase, subsequently you might found some defaults with the goods you purchased. You know, definitely you have to return the goods to the supplier. So this is what happened. We bought the goods and the business we are representing bought the goods from Ekene, and we found some defaults, some problem with the goods. Maybe we decide to return the goods to Ekene worth 200 naira out of 1,000 goods we purchased. So therefore, we are going to record this. When you buy a goods and return it to the supplier, it is called purchase return, or you call it return outward. You call it return outward or purchase return. Purchase return or return outward. Now, think about this. Return goods to a Kenny. We return goods to a Kenny. The business gave out the goods, and who received the goods are taking the goods back to a Kenny. A Kenny is going to receive the goods. Therefore, our debts were reduced. So we are going to open two accounts. Return outwards account, and we are going to open a Kenny account again. Remember, we have a Kenny account. We don't have to open it again. Then it's now we are going to open only return outwards account. So see it here. Purchase return account. Always don't forget the currency sign given in the question. So now, the simple question is, return outward gave out the goods. So we are going to credit return outward because they gave out the goods. 200 naira. We gave it back to a Kenny on 7th 24. The corresponding entry of this will definitely be here. A Kenny account. Where is a Kenny account? So a Kenny account. So we credited here. The corresponding entry will come back here, so that a Kenny's debts will go into reduced. So we come and debit a Kenny with the name purchase return. Purchase return. Purchase return. Purchase return. So we are done with this transaction as well. The next thing is 11 stars paid Ekene his account in full. Remember, 11 stars purchased goods worth 1,000 from Ekene. We return goods worth 200 naira. His remaining balance with us is 800 naira. And here we are told that his account has been settled in full. So therefore, the entire 100 naira has been given back to Ekene. So therefore, we are going to open two accounts here. We are going to open cash account because we paid the money cash. So you come on, credit cash. Cash paid the money. Remember, credit is a giver. You come and write Ekene. Ekene, how much is the money? 800 naira. 800 naira. The corresponding entry for this should go to Ekene account. Then you come to Ekene account, see here. We created here. You know definitely we are going to debit here. 800 naira. 800 naira from cash with the name cash and print. So we have answered the question successfully. If there is anything we need to do now is just to close the respective accounts we've opened. Let's see how to close accounts. When you add this plus this, you have 7,000. You have 7,000. Close the account. Then you minus 800 naira. The balance you get here is what we call balance carried down, but we shorten it as balance CD. What do you mean by balance carried down? The balance you've gotten at the end of the month is what we refer to as balance carried down. It is normally represented as balance CD. So the balance you got at the end of the month, let's say for instance our month here, let's say 30th. Let's say At the ending of this month, the balance you've gotten is what we call balance CD. So 7,000 minus 800 naira, that we are going to have 6,200, right? This is your balance CD here. Come and write, you come and close the account with 7,000. Then you bring this same balance CD. Remember, next month, this will be your opening balance. You are going to bring it here as balance BD. Balance BD 6,200. When we say balance BD, we mean balance brought down. This is the balance you brought from the last month. You are going to continue with it in the beginning of this new month. So let's say this is March. On 1st April, this will be your balance. 1st April, this will be your balance. We have closed this account successfully. The next thing is to close purchase account. Purchase account, just go come and write your balance. See that was 24. Your balance BD. Balance CD is the same 1,000. Close the account. You close the account. Then you bring this same balance CD as your next month's first opening balance. Come and write it here as 1,000. We are done with this account as well. Then this, bring it here, the same 300 naira. Come and write balance CD. Balance CD. Let's say at the end of the month, close the account. This your balance BD CD. You are going to bring it this side as your balance BD. That is the balance you are going to start the next month with. Then you come and bring it as your first and as your balance BD 2024 300 naira. We have done with this account. Then sales account, close it 5,000 as your balance CD on the 31st March. Close the account. Then it comes here at your balance BD. But on 1st April, balance BD 5,000. We are done with this as well. Then this one, you are going to close the account 100 naira as your balance CD 200 naira on 31st March 2024. Close it. Then you bring it here as your balance BD on 1st April. $200. You're done with this one. The rents. Rent balance CD on 31st 24. Close the account. You bring this same balance CD to this side as your balance BD. Balance BD 300 naira, but on 1st April 2024. Then a Kinelaki account. A Kenolaki account has balance itself, so therefore there is no need for BD, there is no need for balance CD and balance BD. Therefore, this is 1000, this is 1000. Why? What is here? 200 naira from 800 plus 800 naira is 1000. Now it's 1000 is here also, so it has balance itself. So there is no need for balance CD or balance BD. The account has cancelled itself. Then capital account, bring it here as your balance CD. Balance CD. Close it here, close it here, and still bring it back on 1st April 24 as your balance BD 2000. We have successfully closed all our respective accounts. We have closed all our respective accounts. So you can see the thing is very, very easy. It is just for you. That's why you see accountants, they don't have to memorize the number of transactions. All they do, they ask what comes in, what goes out, who provided the value, who received the value. When the answer to these questions will automatically reveal the debit or credit. Guys, our today's class ends here. Your simple assignment is just look around, find one transaction, and think about what came in, what's left out of the business, and think about the relevant position to give them. Once you can do that, you are already thinking like an accountant. The next class we are going to see how to open a ledger, how to open trial balance. Thank you.